of two. Okay. Shall I say continue, Roman? Okay.
Yeah. Yes, please.
And yeah, so probably you need a break of 2 weeks after this presentation. So anyway, thanks for joining. If you have a question, you can always raise your hand. I got used to teaching online as well. So you can raise your hand. I'll see your hand. I have 2 screens in front of me. But of course, you can always ask a question on the chat. So this is a joint paper with my co-authors, Ziming, Daral, and you. Ziming and you are from Peking University, and Daral is from University of Hong Kong. And this is actually a very new paper. Honestly, we've just finished it like 3-4 days ago. So it's very, very preliminary. I would appreciate if you don't cite this until we work more on it. So, you know, apologies for any typos or any inconsistencies that you might find if you read the paper. But it's kind of preliminary in the sense that we are still trying to kind of figure out the tests, still trying to improve on our research question and improve on our contribution. And let me just jump straight into this. I know I have only 25 minutes. We are answering a very basic question here, nothing complicated. We are looking at bilateral political relationships between countries and whether these relationships affect the syndicated loan market, and in particular, how foreign banks provide lending to domestic borrowers. Yeah, so cross-border lending. And this is actually a relatively new area. And people in finance, people in economics have been investigating cross-border flows of capital for many years, but not necessarily looking at the debt market, not necessarily looking at the syndicated loan market, and not necessarily investigating the role of political relationships. So in terms of actual tests that we investigate in this paper, we are focusing on 3 sets of variables, 3 sets of outcome variables. The first one is the spreads of these loans, these cross-border loans. And let me just define what a cross-border loan is a loan where the lead arranger and the borrowers are from different countries. So we are looking at the spreads of these loans. We are also looking at the flow of capital, so kind of the flow of loan debt, and we measure that in 2 ways. We look at the amount of loan debt for individual loan contracts, but also the number of deals at the country pair level. And finally, outcome number 3, which is still work in progress and is not reported in the current version of the paper that is posted, we will be looking also at the secondary loan market liquidity. And that's definitely something that nobody has looked at. In fact, nobody has looked at this topic even in any other context, because data on secondary loans trading is actually not really available, and it only came about very, very recently. So I can talk more about that, but at the moment we have, you know, we are still working on matching the data. It's very messy because that secondary loan market data is massive, and we basically have to match it manually. Okay. So at this point, I'll be talking about the first 2 items, but hopefully we'll have something to say on the third very soon. Now, a bit on the motivation behind our paper. There are lots of working papers out there and published papers that look at political relationships and to some extent how they affect global economic flows. But the focus has been mainly on trade, on global equity flows, and to some extent bonds, but not necessarily on syndicated loans. And one of the issues that we have noticed with this literature is that the majority of the evidence presented is at the country level. And the problem with the country level tests is that you always have this danger of reverse causality, in the sense that instead of having political relations driving the outcome variables, whatever flows people look at, you might have the relationship flipped. It might be that the global economic flows are actually contributing to stronger political relationships between countries. So it's very difficult to set this apart in a country level type study. And of course, when you have country level variables or tests, one can always, face this issue of correlated omitted variables. There's always some country specific variable that might drive both variables in the tests, and obviously you have some endogeneity. Yeah. So that's one problem that we noticed in the literature. And the other element is obviously that there's very little on how the debt markets flows are, what are the determinants of debt market flows. And in our case, obviously, we are looking at political relationships. Now, why our setting is interesting, I believe. First of all, because we are looking at borrower level data as opposed to country level data, to some extent, we can avoid this issue of inverse causality, because it is very unlikely that loan terms specific to a particular borrower would influence political relationships at the country level. That would be very unlikely, right? So in a way, of course, we can't have a perfect test here, but at least we mitigate this issue of inverse causality by looking at the borrower level. And in the case of our tests, actually, we are looking at the facility level, which is at the loan level, right? So even below the borrower. So unlikely these terms will influence political relationships. The second element that is interesting here is that this is actually quite a large market. So over the period of our sample, which ends in 2015, the syndicated loan market has grown significantly, and one of the segments within this market, which is the cross-border lending, has grown even more, right? Has grown at a much faster rate. So as you can see, some data here coming from the World Bank, the level of lending, cross-border lending in the syndicated loan market went up 5 times. So it's a significant amount of capital crossing border here in this market, and this is a market of very sophisticated lenders and very sophisticated borrowers. And to some extent, this ties into our research question, because some of these very large banks and some of these very large borrowers do have kind of government relationships, right? If you think about the very large American banks or the very large British banks that provide lending in this market, definitely they're very close to their governments. They closely follow government policies and regulations, guidance, and vice versa. You have borrowers in emerging countries that borrow significant amounts of money through this syndicated loan market, and those borrowers tend to be very connected to their governments as well. They tend to be very large employers and so on. So as a result, to some extent, we believe that we might be capturing something close to a first-order effect in this relationship. Now, another development in the syndicated loan market, which is actually related to the third outcome variable that we plan to investigate, but we didn't have a chance yet, is the fact that the syndicated loan market has been flooded over the last 10 years by a new type of investor, an institutional type investor that is based mainly in the US or Europe, kind of in Europe, mainly London. And these investors are called collateralized loan obligations. And what they do, they usually are part of the syndicate these days, but very often they purchase the loans originated by the very large banks. They purchase them in a secondary market and basically take over the assets from the banks. Yeah? These days, the banks don't have really an incentive to lend to very risky borrowers, and they're very happy to sell significant portions of the syndicated loans to collateralized loan obligations. So I have access to the CLO database, and that tells me which CLOs own these loans, where are the CLO based, who are the CLO managers, and how the CLOs trade the loans. And as a result of this information, we can have access to secondary loan data. Okay, so there's an opportunity here to not just look at relatively sophisticated lenders like banks that have access to private information, but also to look at sophisticated lenders like CLOs who have more limited access to private information, so act more on an arm's length, like in the bond market. So definitely for them, information flows are very important. So we haven't explored the CLO angle and the CLO ownership and trading of these loans. But again, I think that's the opportunity that we have here, especially that a lot of CLOs, they are required by their investors to diversify their portfolios. So if you have a bunch of CLOs based in the US, their investors expect these managers to diversify the portfolio of loans, to invest in loans that are abroad, loans in different currencies, and obviously different industries. So how do we think that these political relationships impact international lending? We have three very basic arguments. The first argument is about information asymmetry, and it really relates to information acquisition costs. There's plenty of literature that I will not bore you with in finance and economics that shows how important it is to have lower information acquisition costs in a lending relationship. But we believe that information acquisition costs are further reduced when you have good bilateral relationships between countries. For instance, you might have a situation where borrowers are more willing to share information with their lenders if their governments, the government of the borrower and the government of the lender, have very good relationships. There is also greater trust between the two parties. And to some extent, there is more pressure to release information. Yeah? So another element is that greater political relationships mitigate a basic effect documented in a lot of papers that show that banks and borrowers have a home bias or a nationalistic proclivity to borrow locally, right? So banks are tempted to lend money to local borrowers, domestic borrowers that they know very well. And with very good relationships, with very good country relationships, these banks will be more willing to go abroad to search for additional borrowers, and vice versa, borrowers would be more willing to deal with banks that come from abroad, especially if they have the comfort that those lenders come from friendly countries. Yeah, and maybe the perception is that if they come from friendly countries, they'll also be accommodating if problems emerge. And finally, there's an enforcement angle here, which is very common to any debt contract, right? Any lender worries about enforcement. And if you have unfriendly countries, then it's more difficult to enforce on your claims, especially if the borrowers end up with problems in the post-contracting period, right? So it might be very difficult to have an injunction on this borrower in the local courts if your country is not on good terms with the country of the borrower. Yeah, there are expropriation risks, and there's some evidence out there that various governments do influence to some extent borrowing terms. They get involved, especially if the lenders or the borrowers are very large in those countries. Now, what is interesting is I think at the end of the day, why does this matter to us, right? I mean, we are looking at certain terms, spreads of these loans, but at the end of the day, cross-border lending really promotes economic development. So it has a very important function. And in the debt market also allows for various countries with limited access to capital or with limited domestic capital, allows them to kind of share the risks with foreign lenders, right? So when countries really need a lot of capital and that capital is not available domestically, or is very risky to lend in that particular country, having these foreign banks coming in from potentially friendly countries allows these governments or these economies to share the risks. The risk being that the borrowers might not be paying on time. And of course, foreign banks, which typically are based in London, New York, so they're very professional type investment banks, they bring some level of monitoring efficiency to these borrowers in emerging markets, and potentially professionalize the borrowing and lending process, right? Bringing some additional benefits to these countries, yeah? So these are the arguments why we think good relationships between countries matter, and the consequences of those relationships in terms of benefits to the society and benefits to the market overall. Now, let me jump into the data. I don't know how much time I have left, but I'm sure Roman, maybe let me know if
around 10 minutes.
10 minutes or so. Okay. Let me just tell you a little bit about the sample and the data. So the typical source of data for loans is DealScan. It's been around for many, many years. And our focus is on a subset of loans within DealScan that have borrowers and lead arrangers in different countries. So this is you can see here the time period, and of course we end up with a significant sample here of close to 20,000 loan facilities. We run our analysis separately, US, non-US. Obviously, US borrowers are very large in the market. It's the largest economy, so and a lot of borrowing as well in this economy. So we wanted to make sure that our results hold also for non-US borrowers. They're not really driven by one country. So you'll see that across the paper, we'll run the results for these two samples of full sample and then the sample without US borrowers. And lead arrangers, I mean, the top 10 countries are really the Western countries that provide these lead arrangers, but in reality, we see lead arrangers based all over the world. There are lots of very, very large banks that lead these syndicated deals even in emerging markets. So it's not really concentrated in UK or US. Now, probably one of the most challenging features of this type of research question is how to measure political relationships. And we come up with country pair measures, and we have two measures. One measure is really employed by other people as well. And you see two papers that validated this particular measure, political affinity. And it's based on the percentage of votes that these countries submit in the UN General Assembly. And they vote on various issues, anything from trade, could be wars, could be environmental issues. But the idea is whether they agree in those votes, whether they both vote yes on a particular issue or they both vote no, then we think that politically they are closer and potentially they have good relationships. Very often between these votes, countries negotiate with each other their positions to make sure that a particular resolution is passed or not. So that's one level that's one measure that we have. The other measure is a measure that we hand collect ourselves painstakingly. And we look at diplomatic meetings between heads of state. And different countries have different systems, right? Some countries have, prime ministers, presidents, whoever is in charge, right? Sometimes a queen, sometimes a king. And we collect this data. One of the main sources of data for this is the US Office of the Historian. And that gives us information on what the US presidents are doing, which countries they are visiting, but also which leaders of state visit US. And then on other countries, we look at Wikipedia, Google searches, and so on. So, but overall, we ended up actually covering close to 96% of our sample, which is quite impressive. So these are the two measures of political relationships. And as you can see, I mean, depending on the sample, but on the main full sample, the political affinity is basically telling us that the average country pair agrees on the voting about 66% of the time. And obviously there's, as you can see here, this significant cross-sectional variation. But one of the most interesting aspects that we find with these two measures is that they are time varying, okay? So even though they are country pair measures, they're actually time varying, which is good, because to some extent, this time series variation allows us to deal with a major problem that one would have with this research question, which is endogeneity, right? And we will make use of this time series variation in some of our tests. Now, here's the one of the main tables in our paper. This is the table that is showing the impact of political affinity on the loan spreads. Obviously, this is an association. But what this shows is that on average, the loan spreads are dropping by anywhere between, 5 to 9.5%. So that's a significant, I would say, drop relative to the average in our sample as a result of these bilateral country relationships. And we'll have some additional tests on this, but this is kind of one of the benchmarks that you can keep in mind for now. Yeah. So political affinity is associated with lower loan spreads. Political affinity is, as you see here, is leading to a 11 to 17 basis points decrease in the loan spreads, which is what I just said earlier, about 5 to 9.5% drop in the average spreads. We also look at some cross-sectional tests. So that's our main test. It's an association test. It has a lot of issues. I'm sure you'll pick up on all those issues. But then we look at, given our arguments that, we expect that political connections might be, or relationships might be more relevant when we have information asymmetry problems, we look at subsamples of firms based on these partitions of, when firms do have significant information asymmetry problems, and we proxy that by the size of the firm, whether the firm is rated or not. So unrated firms have bigger problems, and companies that are financially constrained, or companies that issue a loan in the syndicated loan market for the first time. The market doesn't know them very well. But in all these instances, as you can see, these types of borrowers end up with much higher loan spreads. However, once we condition on the existence of this bilateral good relationships between countries, then these effects are mitigated. So they end up with sometimes on average negative spreads just because of this relationship. Again, another association test. I don't want to put too much on this, but it shows you that our results do hold in certain subsamples, and they move in the direction that we expect. Some additional cross-sectional evidence on the enforcement mechanisms. And here, again, I will not go through all these variables, but suffice to say that these country-level variables do matter, and the political connections either facilitate or complement some of these country-level variables. But again, the signs are consistent with our expectations that political affinity or political relationships do improve the information environment, do decrease the concerns that lenders have about credit risks. Now, of course, if we were to stop there and say, okay, we are documenting lower loan spreads, this could be also driven by changes in other loan terms, right? So you can have lower loan spreads, but at the same time, maybe now you will end up with lower loan amounts as well. You might end up with more covenants. You might end up with shorter maturities. So we look at these other loan-specific variables just to make sure that we are not really documenting any trade-offs within the set of loan terms. And we don't seem to find that at all, right? As you can see, we document higher loan amounts and actually fewer covenants. If there was a trade-off between the loan spreads and these other loan terms, you'd probably expect to see more loan covenants as opposed to fewer covenants. Yeah. There is also some evidence that the number of banks in the syndicate is increasing, and this again may be consistent with the interpretation that the information asymmetry even between lenders is decreasing, not just between lenders and borrowers. Yeah, we don't make such a big deal out of this, but this is just with the purpose of providing the full information. our next set of tests is to look at the flows of capital, and what we document here, and all these tests are at the country pair level, we document that greater political relationships lead to more loan deals, greater number of deals, and a larger amounts of debt being actually lent to those borrowers in these other countries that are friendly. Yeah. And we have some evidence showing that, I mean, this effect is actually quite significant. I mean, we are talking about anywhere between 15 to 26% increase in the number of deals, but in terms of the total loan amount, the impact is actually even bigger. We are talking about 98% increase to 136% increase in the total amount of debt. So look, I'm not saying this is causal at this point, but the effect is so significant that one can only wonder if there's something else going on here. But certainly the effect is very, very strong. Yeah. Now we replicate the same thing with our diplomatic meetings, and the beauty of this measure is that we know exactly when leaders meet. Okay, we know when they meet, and the treatment firm. And so we do a diff in diff type analysis here. The treatment is the pair that has a loan, the country pair that has a loan immediately after the diplomatic meeting. Okay, and the control is other country pairs that do not have any loans, or they have loans in every year, right? As you can see, this diff and diff test shows us that immediately after the meeting, you see a benefit in terms of the loan spread. So see, here is where we kind of make use of the time series variation in our measure. And here I'm a little bit more aggressive, even in the title of the slide. Maybe diplomatic meetings do lead to lower loan spreads. So in other words, we might be able here to make a causal statement. Again, I have to be very careful about that. Yeah, but at least the evidence with this new measure that we have been collecting, which is relatively accurate, shows that definitely these relationships do matter. And I can give you a lot of anecdotes where these leaders, when they come to visit other countries, representatives of the borrowers join them as well on these meetings, on these diplomatic meetings, or when they come to a particular country, they actually do meet lenders themselves. We just have to collect a little bit more data to provide even more causal inferences there, provide more comfort. The same, we replicate it for the number of deals, and the total loan amount gets similar results with these other measures. Again, suggesting that diplomatic meetings lead to greater debt flows. Then we run a bunch of robustness tests. There is we go all the way with the fixed effect specifications, right? We tried every possible permutation of fixed effects, went to the lender fixed effects, borrower fixed effects, country-specific fixed effects in case we are missing on something is country-specific, and we continue to get these results quite robust. Now, we have investigated two other settings that allow us to have this diff and diff design. One is the war in Iraq. So there we look in particular at US lenders and French borrowers. So the Iraqi war, so we only look at the deals around the Iraqi war, the year before and the year after, and focus only on US lenders and French borrowers. Yeah, that was the period when in the US everybody was eating freedom fries as opposed to French fries. Yeah, but we see a significant impact there, right? We see that actually French borrowers end up paying a lot more in interest spreads just immediately after that event happened. Yeah, and then we also look at the great global financial crisis, and I don't have to show you you can look yourself at the evidence, but what we find there is that generally borrowers end up with worse terms as a result of the crisis. They end up borrowing less because there was a liquidity squeeze. They end up paying higher spreads. But if those borrowers were in countries that were very friendly, according to our measures, very friendly to the countries that where the lenders originated or the lead arrangers originated, then that country relationship mitigated all those effects. So they ended up with lower interest rates and actually more debt, even during the global credit crisis because of these relationships. Again, just another piece of evidence that hopefully completes the puzzle to some extent. But what we plan to do next is to look at the secondary market trading. And the secondary market trading of these loans allows us to, with very high accuracy to pinpoint in time how these spreads are changing as a result of diplomatic meetings. Yeah.
Sorry, Florin, given that we have a lot of questions, let's conclude.
Okay, let me just conclude, Roman. So you knew that this slide is coming. Thank you. So two very basic conclusions here. Lenders accept lower spreads and they're willing to provide more debt when these countries have very good bilateral relationships. And really, that's the contribution that we think we bring to the literature here, just to show high level that political relationships do have some positive spillover effects in the syndicated loan market, which is a market of relatively sophisticated lenders. That's all I had to say, Roman. Thank you.
Florin, thank you very much for a great presentation. So now we'll switch to the Q&A session. And the first question is from Joan.
Aloha, Florin. I enjoyed your talk. I wonder whether a country's GDP per capita level, GDP growth, and the stock market affect this kind of behavior. Because some countries are kind of more like equity financing, like the US. Some countries are more like bank financing, like Germany.
Yeah. So I think, thank you. I mean, we did control for a bunch of country-specific characteristics, including GDP and, kind of similarity between the countries. So we look at similarity across, cultures, similarity across, geographic proximity and all that. But I don't think we looked at the extent to which a country's debt market is developed relative to its equity market. But certainly that's something that we could look at.
So when you control for a country's GDP, did you control for the growth of the GDP? Because if a country is growing very quickly, maybe there's more demand.
Yeah. We control for the GDP growth as far as I remember. Yeah, we have a lot of control variables there, but I believe we control for. But in any case, we always have country fixed effects and country year fixed effects.
That helps. And my other question is, how does the role of development banks or IMF, for example, like Asia Infrastructure Investment Bank, so how this bank's behavior affect the debt market? Are they complementary or are they substitutes? Are kind of like private lenders encouraged by the development bank, or they kind of substituted by the development banks?
I think that's a very interesting comment. Thank you, Jean. I mean, we have not looked at that, but my guess, I mean, this would add a very interesting, I think, dimension to the paper, because now we would be able to understand how this, kind of the arm's length private syndicated loan market complements this institutional lending provided by developmental institutions like World Bank, IMF. So we didn't look at that, but I think it's a very interesting angle to pursue. Thank you. And I believe that hopefully those institutions make their data available. So I don't know how we can get that data, but I know that a lot of developmental institutions lend to borrowers in those countries. So I guess, and it might be a condition, right? In order to get that type of borrowing, which is usually subsidized or is below market levels, one might need to first access the syndicated loan market to provide those developmental institutions with some comfort that the borrowers are doing the right things. But we haven't looked at that. I think it's very...
Thank you.
Thank you very much for your comment.
Thank you. So the next question is from Tyler.
Yeah, I was just wondering, you talk about these arrangers, and I believe you use the headquarters as, where they're located.
Yeah.
But I'm thinking these large banks that are doing this, Goldman Sachs is multinational company. Is it just that they're offering lower rates to countries where they also have a physical presence?
We are not able to look at whether they have a physical presence in a particular country. But I mean, I don't know. So you are thinking that, if Goldman Sachs has an office in a particular country, I mean, we are looking at very large loans here. So even if Goldman Sachs would have an office in that particular country, my guess, given the size of these loans, my guess is that some level of approval would still come from the head office of the bank. But
yeah, I guess what I'm thinking more is that, if we think about like information asymmetry, recourse, and being able to, go after defaulted loans, if you have a presence in the country where you're lending, right, you probably have less information asymmetry, more recourse, because you're not just a foreign company, you actually have a domestic presence there.
Makes perfect sense to me, Tyler. I agree with this. I mean, I wonder if we can collect this data, and it might be interesting to show some sort of substitution effect, right? So if you don't have a local office, then maybe the country level relationships will matter more. So it could potentially be another cross-sectional test in our paper. That's interesting. So definitely, I guess we can. I mean, it's not like we have too many country. I mean, we have a lot of country pairs, but at the end of the day, we might be able to collect this data. It's easy for me to say because I'm not the one maybe doing this, but I think we could look into this, right? I don't want to commit, but I think it's useful. Thank you very much.
Thank you.
All right, thanks. So our next question is from Doug.
Hello, Florin.
Hi, Doug.
I think the contribution of this paper is going to be judged largely by your ability to overcome the problems associated with endogeneity. I know that endogeneity is a cheap and unfair thing to ask about, but for two reasons, I think there are sort of above average challenges associated with this paper. The first is there's a huge body of possible economic data that your measure of political connectedness, whichever measure you decide to use, is potentially associated with. And secondly, the idea of political connectedness is not very well defined idea. It could be measured in so many different ways. And the example you use of the US and France at issue during the Iraq War, it could come down to things as simple as, do we like each other? So I think the primary hurdle here is to attribute your findings to something about political connectedness that maybe you could undertake some effort to more precisely define?
Yeah, I mean, the best we could think of, and I absolutely agree with you, by the way, I'm in full agreement with your concern. I think that's the main hurdle that we need to pass here. And the best we could think of is these diplomatic meetings, right? Because we can zoom in there, we can see what happens immediately after the meeting, to the extent that there is a lending relationship occurring immediately after. And but I guess what you are after is maybe something even more accurate, right? And I don't know if I mean, my thought was, can we see the members of the delegation that are joining the head of state to, on that particular visit? And you might be able to see the CEO of the borrower or the CEO of the lender being there.
Well, a couple of comments on that. Diplomatic visits don't happen in a vacuum. They're not exogenous.
Yeah.
We're visiting countries that we're probably doing more trade with and that we already get along better with. And that starts to sound an awful lot like political connectedness to me. So I don't dispute any of your empirical findings. I'm just having trouble convincing myself that I know what the causal factor is. And you referred to this in your discussion a couple of times. I think that's really critical in this paper.
Yeah, I agree with you. I mean, but you see, we are trying to capture with our measure different levels of political connectedness. So I'm not disputing that a country is head that is visiting another country, that the two countries might have, prior to the meeting, very strong relationships. But what we are documenting, at least with the diplomatic meeting variable, is that conditional on the existing relationship between these two countries, which was prior to the meeting, there is an improvement immediately after the meeting, right? So the political connection is stronger immediately after the meeting, as one would expect. I think what we could do, but that's very challenging, and I thought about it, is to try to assess whether these meetings are successful or not. And but at the moment, what we show is that given the level of connection between the two countries, immediately after the meeting, there's an additional improvement, at least with respect to this syndicated loan terms. But I mean, obviously, it's not an easy task, right, to find something else. And but again, I fully agree with you. I think this is the hurdle that we need to pass here.
Okay, good luck with the paper.
Thank you. Thank you very much, Doug.
All right, thank you. So the next question.
In addition to Doug's point, because I definitely agree this is the core issue here. And that's why we are trying to look into secondary data, because the secondary data will allow us to isolate even more the effect, because now I have trading data in the secondary loan market that happens sometimes on a daily basis, so that I can immediately check in the secondary loan market how the prices of these loans adjust as a result of a visit, okay? And that's really the best I can think of at the moment. Sorry, Roman.
No, sorry. So the next question is from Sichi.
Hi, Professor. Thank you very much for the presentation. I have a quick question for the explanations of Table 5. Because for Panel A, it is for a full sample, and the Panel B is without US borrowers. And for Panel A, the weak credit rights and the intersection of weak credit rights and political affinity are not significant. But for the Panel B without US borrowers, they are both significant. My question is why sample without US borrowers has significant results for weak credit right, and how can we interpret it? Should we attribute to different features or characteristics of US borrowers or US credit right? How do you think? Thank you.
I mean, yeah, I mean, indeed, that one variable on weak credit rights is not really loading in the full sample. And I mean, it's the only one that doesn't load there. You know, I'm not sure what the explanation is really. I mean, obviously it's just an average result. And I think we should look more into it to see what is driving that lack of significance. But, you know, sometimes, I mean, to some extent, the country level variables are correlated, but to some other extent, obviously the results don't always converge. But I don't think I can provide, let's say, an articulate explanation as to why we find it in a panel, but not in another one, right? I mean, I potentially can come up with a story, but it's also a function of the composition of the sample as well. And I'm sure that if you were to partition the sample even more, we would get or not the results, right? And you can maybe come up with a story around it. And, you know, kind of, there's this saying, I mean, the more you pressure the data, the more you interview the data, if you want, the more the data will speak, right? So I guess if you start, and you know, if you start partitioning the data to an extreme, you probably end up finding results that you expect, right?
Okay,
But,
thank you.
Yeah, thanks for pointing that out. We'll look into it.
Thanks.
All right, thank you. So the next question is from Tyler again.
Yeah, thought my question was down later, but I was kind of wondering with the diff and diff designs that you have in the paper, you know, you don't really go in too much into showing that there are parallel trends, you know, before the treatment. And I think that that might be useful.
Yeah.
And then particularly in the France example, I think there's only 2 observations, you know, in the treat times post. And I'm just wondering how much really we can infer from this, given, you know, we really only have basically 1 or 2 loans that you're looking at, you know, after that shock.
I think we have more than that. I mean, let me just, I was just looking now at the sample. I'm a bit surprised that you say only 2 or 3. I thought we have, I see you're looking at, yeah, I mean, we can definitely look more into this, right? But it would be definitely useful to show the parallel trends. I definitely agree with you. I think that's an obvious thing that we should do. And it will be in the next version of the paper. And maybe we'll also show some, you know, we'll show the results in a graphical representation as well. That sometimes is a bit more intuitive. But
yeah, and then there's one other comment on that too. I was wondering, you kind of mentioned at the beginning of the presentation that there is variation in these voting kind of records. And I was wondering if you couldn't use that kind of, you know, if you measure some cutoff point, you know, where we see that there is a high political versus a low political affinity, you know, and if you have countries moving between, you know, high political affinity and low political affinity, that you couldn't do kind of a staggered diff and diff with that as well.
Yeah. I mean, that's a natural thing to do, right? And I absolutely agree with you. We didn't have a chance to look into changes in that. And these changes do occur because presidents change with electoral cycles, right? So sometimes 2 countries are very close because the presidents or the prime ministers form a, you know, personal relationship, and then the same country pair changes completely when the president or the prime minister changes. So right. I think we should definitely look at that. I mean, we didn't have a chance to look at the changes, and my thought was to look at the changes in that variable and to even identify shocks into that variable. We just need to define what a shock is, right? Now, one element of that variable is that at this point, the variable is a little bit blind, right? We just look at the overall voting in the UN Assembly, but we don't really distinguish between what we would call important issues and less important issues. Sometimes, you know, for instance, you might have 2 countries that agree significantly on a lot of minor issues, but disagree on the important issues. And I think we can refine the measure a little bit more, but definitely looking at changes and a staggered approach, I like that suggestion a lot. Thank you very much, Tyler.
Thank you.
Thank you. I actually had a similar question a little later, whether you can, you know, exploit the changes when you have 2 companies, right? And, you know, relation change, what happens?
Yeah.
Right. Also, my apologies, I skipped one question by Siva. Siva, please ask your question. Sorry.
All right. Thank you. What was bothering me about the paper was that this from an optimal point of view, if the lender has no connection to the government in which the lender is of the country in which the lender is located, I mean, this doesn't look like an optimal thing to do. I mean, because the lender is leaving money on the table. And why would they leave money on the table unless there was some pressure from their own government? And the only way that pressure can come about is if the government owns some shares in the lender's bank. I mean, I assume it's some finance company or a bank. The lender, the government owns the shares or something. I mean, if it was just, I mean, I cannot imagine like Citibank or Merrill Lynch or Goldman Sachs saying, okay, all right, I'm going to offer a loan to some company in France at a lower rate because the U.S. government happens to like the French government. So I think somewhere you got to, I mean, I'm sure you can find the data on the ownership, the government ownership, either on the both on the lender side, especially on the lender side, and also on the borrower side. The borrower side, if the government of the country in which the borrower is located also owns shares in the borrower. That was my point.
I fully agree with that, Siva. I mean, excellent points. Thank you very much. Obviously, what we document in our paper are average results. And what you are suggesting to us is that there could be some additional interesting cross-sectional tests if you were to look at the ownership of both sides. And of course, American banks are not owned by the American government. They're all in private. But in other countries, in developing countries, the government might own a significant stake in those banks, and the government might push those banks to provide more favorable lending terms. I mean, to some extent, I have two answers to that. First of all, indeed, if that's the case and we show the result, then we can tie that to potentially government pressure, and that's why they would leave the money on the table. But the other response to that is that it is possible, even in a situation where you have an American bank lending to a French borrower, it is possible that as a result of an improved relationship between the countries, now American lenders have greater access to those borrowers, right? And maybe in the past, those borrowers would not consider maybe using a US lender. Definitely, this is a very competitive market. And I should say, Siva, that the lead arranger, which is the proxy that we use for the location of the lender versus the borrower, the lead arranger is actually not really the main provider of capital here. It's just the bank that puts the deal together, and as a result, it attracts a lot of fees, okay? So most of the lead arrangers make money in these deals from arrangement fees, and to the extent that their own government facilitates a deal like that, where they can get a lot of arrangement fees, they might be willing to accept or to push lower spreads for the other members of the syndicate, right? But certainly, I think it's an element that we could look at. Who owns these banks? Who owns the borrowers? Yeah. But let me just reemphasize here that the lead banks have, in fact, quite limited exposure to these borrowers, and most of their revenues come from the arrangement fees. But they are the ones that provide information to the other members of the syndicate. They are the ones that really raise the money. You can think of them as being underwriters to some extent. And they're the ones that basically control the information flows between the borrower and the lenders. But they don't have, each individual borrower in the syndicate, they have their own fiduciary duty to do due diligence on the borrower. That's the theory, but in practice, they do rely a lot on the reputation of the lead arranger.
Thank you. Thank you for your response.
Thank you, Siva. But yeah, we'll try to see if we can find some data on ownership. And I think we could find some data on government ownership, especially in emerging markets, because most of the banks there are owned by governments.
Okay.
All right, thank you. So Daniel communicated privately that you have already addressed his question. So the next question is from Emmanuel.
Hey, Florin. So I think you actually kind of got at it just then. I was wondering, with the diplomatic meeting results, given the lending happens and the favorable terms happen so quickly afterwards, I was trying to map that into which of those mechanisms beginning kind of explained that, and it just wasn't making a whole lot of sort of sense to me. I mean, I almost viewed it like, does a lender see that there's a diplomatic meeting and now maybe the two countries will have closer economic ties, and therefore this lender sees now they might be able to get into a new market or something like that? Is that kind of the...
Yeah, I mean, we didn't
story,
explore the mechanisms yet. And you're absolutely right. For the first measure, we did look at some mechanisms, right? What exactly is driving the relationship?
Right.
So one of the mechanisms was basically, is this diplomatic meeting mitigating information asymmetry or information collection costs? Or is this meeting kind of lowers lenders' worries about enforcement, right? In the post-contracting period.
Yeah, I could see the latter more than the information asymmetry argument. Like, you just kind of wonder if the countries haven't really had good ties before. You see a diplomatic meeting, maybe that means, you know, trade deals will be reached in the future, things like that. And then the lenders see this as a new market to get into, the borrower sees it as... All right, so that's what you have in mind when you say, I guess, in honestly, this also comes back to Doug's point, which is, what are you trying to, like, how do I think of political affinity or political connectedness? Like, what does that kind of mean? Because I thought at the beginning you wanted to abstract away from like the economic ties.
Yeah.
A little bit, right, with political. But then I also think, when I think of voting, on how they vote, if two countries vote for the same resolution, I mean, usually they might be doing it for economic incentives. So the other sort of mini question I had was, did you know the types of resolutions they're voting on?
We do.
Sort of, right. So you can
average across all those. Now, as I was mentioning earlier, I think it would be valuable to look at the particular issues they vote on. But
yeah, exactly, right.
Events, right? You know, voting on resolutions to impose, I don't know, restrictions on some other countries, or to impose...
Yeah, I mean, if you see they're voting the same way to ease sanctions on a given country, that to me is much more a political affinity than, you know, some other type of resolution, something like that. So yeah, if you can play around with that, you might get a tighter measure using the voting, right?
I mean, on the diplomatic meetings, what initially what we tried to do is to say, okay, if they meet, let's look at the press releases to see what they announce after the meetings, right? Because sometimes they announce a lot of trade deals. They announce a lot of joint projects, right? Now, it turns out it's extremely challenging to collect that data globally over this long period of time. But probably we can do a little bit better there, right? I mean, at this point, we looked at the very basic, right, measure. They met, and what happens immediately after the meeting, under the assumption that the meeting was successful, right? But some of the meetings might not be successful, right? But I think on average, the reason why two heads of state meet, I'm only speculating right now, is because they have already, you know, their advisors, they have already agreed that something will happen positively between the two leaders. Otherwise, they wouldn't meet to end up in a awkward situation, right? But so we can do a little bit more to code those meetings. It's just a matter of time and data collection, I guess. But I agree. I think we are all in agreement here that more needs to be done on this. I mean, whatever we try to do, right, it will never be perfect, right? I mean, endogeneity and you know, correlated omitted variables will always be there. So that's why my instinct is to go towards the syndicated loan data in the secondary market to basically see reactions on the prices of these loans as a result of this, of time series changes in these political relations between countries. But again, you know, I mean, I still have to acknowledge Doug's point. It's a kind of it's not clear, you know, what we are trying to measure here. What is political connectedness, right? It's like people in finance trying to define what is firm risk. We don't know it. We can't really observe it. But I guess you'll always face this issue. But I fully agree with, I mean, we can definitely do more.
Okay, thanks. Sorry, I think I took up time.
Thank you. You know, we're already over time. Let's just take one more question from Ini and then we'll end there.
Okay. Hi, Florin. Thank you very much for your nice presentation. I'm actually wondering if the borrowers have significant operation in the lead arranger's local country, then do you see the borrower's foreign subsidiary might be playing a part in accessing local lenders?
That's possible as well. I mean, we can try to look at that, right? I mean, as you can see, there are, in a way, all your questions, including your, you know, all the questions that I received so far, including yours, basically show that there are good opportunities for us to further add tests and improve the paper. So we haven't looked at that really. There is an element of this for sure. Now, most of the lending that happens in this market happens at the parent company level. So if, you know, sometimes the lending happens at the subsidiary level, but because the syndicated loans are so large, to some extent, we are comfortable that it is actually the overall borrower that is borrowing this. But maybe having a subsidiary in the country of the lender further mitigates information asymmetry and information collection costs. And maybe that, you see, it is even possible that the assets of that subsidiary might be used as collateral. I mean, these are lots of things that we can't really observe in the loan contract, but that's possible as well, right?
Okay.
But
thank you very much.
Could be yet another cross-sectional test to look at to some extent. Thank you very much.
Thank you very much.
All right. Thank you very much, Florin, for presenting your research and, you know, giving discussion.
Still early stage, but I thank you. I mean, really appreciate all the comments, and this is very useful for us at this stage. And given that it's so fresh, we'll go back to the drawing board and rethink some of the tests and hopefully improve it.
Thank you. Thank you. And, you know, if anybody else has any questions or comments, please feel free to email them to the authors directly. Thank you very much for joining, and happy 4th of July. Thank you.
Thank you very much, Roman. Thank you, Maya. Thank you, guys. Really appreciate it.
Cheers.
Take care.
Thank you, everyone.